Hello, this is Cynthia Fick, and this is the April 1st stock market update. Wish I could tell a joke about April Fools, but I'm not going to go there today. Just talking about all the uncertainty in the market, I think it's important to point out what the market is really facing right now. We've got all the uncertainty about the Federal Reserve. Are they going to lower interest rates? Is inflation really settling down? Are we going to go into recession? So we're kind of faced with all those kind of fears and concerns. We're also faced with tariffs, and are companies going to be able to pass those along to the consumer, or are they going to have to take the hit and eat the tariff and lower their margins and therefore their earnings? So this is what's kind of hanging over the stock market's head right now. And then tomorrow, we're supposed to find out, more about what the tariffs are going to look like. But we really don't have any idea how they might affect the economy, and corporate earnings on into the future. So this is what's the overhang of the market right now. I know consumer sentiment, investor sentiment is some of the lowest since 1990, 2009, and 2025 are right up there. We haven't even had the kind of pullback in the stock market that we had in 2009, but investor sentiment is just as bad as it was then. So that's how uncertain and unclear things are right now. So with that being said, I want to point out some things that have happened in the market that have caused us to make a little bit of shifts in how we're investing your portfolios. And that is looking at a chart of the S&P 500. And something happened last Friday that was a little concerning. And this chart pattern, we had busted through the 200-day moving average. And then Tuesday stock market update last week, Matt said that we were holding certain levels. The market had tried to rally and repair the breakdown we'd had. Well, the exact opposite thing happened. And on Friday, we had a big, huge distribution day on higher volume. And this is what's called an inverse flag pattern. Technically speaking, technical analysis, which we use a lot. And 65% of the time that this kind of pattern happens, there's going to be further downside in the stock market. Again, we're, speaking the day before the information on the tariffs come back, and there's for sure going to be a kind of a crazy reaction. We could be up big, or we could have a negative reaction. Not sure what's going to happen. But with everything that we see in front of us, we think it's prudent just to take a little bit of money off the table. And that is not trying to time the market. That's not what this is called. This is called de-risking, taking some of the risk out of your portfolios. It's just prudent. It makes sense. The market may respond well to what happens with the tariffs tomorrow. We're not really sure, but will it be sustainable? We're just not sure. So this pattern, and that 65% of the time the stock market has further room to go on the downside at some point, is one of the things we look at. The other thing is, and you'll recognize this for those of you who've been with me for a long time, it looks a little different than it used to, but our bull bear indicator chart, it went bear. It went bear yesterday. And so that doesn't mean, we're going to go down 50% or anything like that, but it just means, buckle up. There could be some downside in the market. You can see every time that it went bear in the past, that's these, red periods of time, the market, the S&P 500 has gone down. And the only time it didn't go bear when the market went down was 2020 with the COVID correction, and that was in big part, because it was so quick. So this looks like what is a normal correction, about 10% we've had so far with the S&P 500. That's from its high, could turn into something more what they call a bear market. And a bear market is when the stock market, all the different averages, S&P 500, Dow Jones, go down 20%. So not saying that's going to happen. I'm just saying that then the market, it would become a bear. This signal is just saying it's become less positive for stocks. And it's not a bad idea right now to take a little bit of money off the table. And that's what we've done. We've kind of just skimmed off for everybody who was maybe a little overweighted. raise some cash. And again, cash will give you a cushion if there is more downside of the market, and also give you some dry powder because we want to have some money to be able to buy some things. So we kind of called off some of the things in our portfolios that have done, I'd say the least over the last few years. And, that's what we're doing. For those of you who are new to us and maybe have a lot of cash, we didn't necessarily need to do that because you have a lot of dry powder. And so that's what we're going to be taking advantage of at some point. I do believe this will turn into the buying opportunity of a lifetime. I'm just not so sure, it's going to happen in the next month, 2 months. And so that's why we decided to take a prudent move, raise a little cash, get a little bit more defensive, and we will let the market show us what it wants to do. And if it continues to talk us out of it a little bit more, we'll just slowly continue to skim and raise cash. So you're in a much more defensive position. So don't like to do this. It's not easy, but it's what we said we would do. And we'll just go from here. So hope you have a great week, and we will talk to you next Tuesday. Bye.